Welcome to Investors Guide. You're watching ET Now. Thank you so much for tuning in. This is a show that helps you find the perfect investment products in the market so you can put it together and create a portfolio that will make you rich in the long term. You can write to us. Our email ID is flashing at the bottom of your screen right now. Send in any question you have about your money. And before we go any further, a quick reminder, we have a brand new show brought to you by the same team called The Property Guide. That's on your screen. These are the show times of The Property Guide. Also, Investors Guide has some new telecast timings as well. That's on your screen, and that's the timing of Investors Guide on ET Now. On the show this week, if you're a young man saving for your child and for your own future, we'll tell you how to work inflation into all of that math. In our product review, we look at the DSP BlackRock Tiger Fund, and we'll tell you how you should prioritize all of the various goals and aims you have so you can start investing today. Let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Dhirendra, thank you so much for joining us on Investors Guide. It's always a pleasure to have you on this show. Let's get straight to our portfolio question. Well, 30-year-old Chetan has written in, Dhirendra. He writes in from Mumbai. He has two lovely children, a 3-year-old daughter and a 1-year-old son. And as you can assume, he wants to save for their future. Now, he tells us between he and his wife, he saves about 30,000 rupees every month, and they expect about a 10% raise in their income over the next year. He currently has 2 homes. He has a running home loan on the second home, and he's hoping to pay that off by 2019. That's his plan. He seems to have about 5 lakh rupees health insurance from his employer. He also has a term cover of 50 lakh rupees plus a home loan term cover of 50 lakh rupees. Now, that's impressive. Now, given the fact that he wants to save for his daughter and his son, he wants to know how he should go about, to begin with, arriving at a target for both of their education. Now, Dhirendra, we keep talking about this on the show. We tell our viewers to work in inflation. But for a layperson sitting at home who's saving about 30,000 rupees every month, how can he work in inflation? Tell us how to do the math on that calculation.
Just saving is not enough, and making it, compound faster than the rate of inflation is very important for your money to actually grow. And when you are investing for a specific goal, I think, it's all the more important that you look at your savings and the way to it will be deployed. I think the very basic estimate one should do is at least find out the current cost of higher education, if that is your goal, that one should be reasonably prepared with. And factor in at least as much as the inflation. Assume about 7.5% at least. So compound, do the current estimation. How much will it require? How much will you need today? And then the time frame that you have, you need the money after 17 years, compounded by 7-8% at least. And that should be your goal. And the important thing is that, your money should be working harder, faster than the inflation.
So that's what you have to do, like Dhirendra said, figure out what it would cost right now to put both of your children in college, and then work in an 8% inflation. So compound it for 8% every year for the next 15 to 20 years, which is your time horizon, and that's how you'll arrive at that amount. Well, Dhirendra, obviously, like you always recommend, one needs to invest in equity to beat inflation, and he's doing that. Out of the 30,000 rupees he saves every month, he puts 20,000 rupees in mutual funds, and he sent us a list of the funds that he has. He has the DSP BlackRock Top 100, IDFC Premier Equity, ICICI Prudential Focus Blue Chip, HDFC Top 200, Birla Sun Life Frontline Equity, Reliance Growth, the Gold Fund from Birla Sun Life, Quantum Long Term, and Reliance Regular Savings Equity. So this is obviously a young man who watches our show on a regular basis. A lot of these funds are funds that you personally recommend. Would you like him to make any changes, or is this portfolio, on track the way it is right now?
I think he has chosen good funds, but he has not actually got rid of the not so good funds anymore. The other thing is that, we have always kept away from the gold as an allocation. So he should seriously consider that as a long-term investment. And if we have to, match one of our portfolios to his requirement and the kind of time frame he has, I would urge him to, get into our growth portfolio and aggressive growth portfolio. And And by mapping his investments to that portfolio, he'll be able to reduce his number of investments as well.
Alright, so reduce your number of investments and use our aggressive growth portfolio. It looks a lot like your current portfolio. Last question, Dhirendra, 10,000 rupees not accounted for from his savings right now. What would you like him to do with that money? He hasn't mentioned a contingency fund. Should he start putting one together?
Yeah, I think, he should certainly, with so young kids, he must have the emergency fund. And beyond that, if he should be investing more, then he should just increase his allocation to the aggressive growth portfolio.
Alright, so that's the advice that Dhirendra is giving you. Now remember, you can get back in touch with us if you have any more questions, especially when it comes to investing for your children. Our email ID is on your screen. Let's move on to our next question. Dhirendra, Neville has written in, he invested 3 lakh rupees in the HDFC equity fund in 2 tranches in 2 separate years. So he's put 2 lump sum investments into this fund. He tells us he is disappointed with the returns he's received so far. He wants to know, should he book his losses or continue this investment at this point? So he's made one very drastic mistake here, which is investing in lump sum. He's also invested in only one fund. So he's broken 2 of your rules. What can he do now?
No, of course he has broken, but this fund has been disappointing. And this has been disappointing for known reasons. The fund manager has taken a bet and continues to continue to believe in those bets. This fund actually gets me the largest number of questions. And so even if he would have been a regular investor, he would have been just as disappointed. I would say that the way to mitigate this disappointment or, reduce your disappointment is to take out 75% of your money and put that money into 3 other funds. And maybe spread your investment over the next 6 months. There are, we see that markets, big ups and downs in the market on a day-to-day basis. You should be able to average it, and that should come to your advantage. And that will also reduce the anxiety. The other anxiety that has been caused here is that you invested 3 lakh rupees, you have not averaged it, and now you see it not going up or falling in value marginally, and the time has gone by. And, a lot of investors also are comparing with, your benchmark is the fixed deposit, a missed opportunity of 9.5%. But that is not the way to look at equity. Equities are always disappointing for a long period. And when you invest through that period, is that it proves to be more rewarding.
Alright, like Dhirendra was saying, it's important not to compare apples with oranges. So don't compare your equity fund with how a fixed deposit is doing right now. What you need to do is compare it with other equity funds and compare it with the Sensex or the Nifty if you want to. And if you're wondering how you can do that, of course, you can take a look at valueresearchonline.com. You can make a lot of those comparisons on that website and see how your fund is doing. It'll help you get a better idea of that performance. Well, we have a question that's coming from the UAE from Jaideep Chatterjee, who's 46 years old. Jaideep, I hope you're enjoying your long extended Eid break there in the Gulf. He tells us he has 75 lakh rupees and his bank has promised him an interest of 9.5% between a period of 5 to 10 years. But, Dhirendra, he wants to know if he can invest that money elsewhere to maybe generate a return of about 15% annualized over the next 10 years. Which one would you recommend he does? Should he be protecting his capital at 9.5%? Or would you recommend that over 10 years he should go for the 15% instead? So that obviously means he'll have to invest in equity. How much of a risk will it be investing in equity over 10 years, Dhirendra?
For a person who is, who's claiming to be risk averse, who might be averse to, the ups and downs in value on a day-to-day basis, it's very important to, invest in a manner so that he's able to manage his anxiety better. So for him, I would suggest a very, a slightly different kind of, not a hybrid allocation in the same fund or something like that. I would suggest that, 50% of his money should be into fixed deposit. Rest of the money, half his money he should invest in an equity fund, in 1 or 2 equity fund, or maybe the balance fund, which will be treated like an equity and it will be, so maybe, 2 funds from our stable growth portfolio. And this is a fairly conservative take. One is that his overall allocation to fixed income will be about 60-70% because half his money will be in fixed deposit anyway.
Alright, Jaideep, our stable growth portfolio is on your screen right now, and Dhirendra is recommending this portfolio to you because you've mentioned the fact that you're not comfortable taking a lot of risk. So this is a conservative approach to investing in equity. If you have any more questions about investing our money, feel free to write to us. Our email ID is at the bottom of your screen. Coming up on the other side of this break, we'll review the DSP BlackRock Tiger Fund. We'll find out if, the changes made over the last 1 year means that you should consider this fund at all, or is it time to write it off entirely? Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for our product review. And this week we're looking at the DSP BlackRock Tiger Fund. Avan is here to give us an introduction. Avan.
Thanks for that, Faye. Well, the DSP BlackRock Tiger Fund started as an infrastructure fund in 2004 to capitalize on the attention that the infrastructure sector was receiving. But the crash of 2008 brought with it an extended period during which infra funds were out of favor. In June last year, the fund witnessed a change in management and in its investment strategy. So the fund now invests in infrastructure-related sectors and sectors that are subject to government reforms. The fund's investments encompass roughly 75% of the Indian equity universe. Its recent performance has been in line with the rest of the infrastructure sector, which has remained out of favor. Even though the fund has climbed to number 3 in its category, investors would do well to remember that this sector is cyclical. Let's do some math to give you a better perspective. If you invested 1,000 rupees in this fund when it launched, which is nearly 10 years ago, you would have 3,787 rupees today. So should you pull your money out of this fund or remain invested? Our experts are here to give you the answer. With that, it's back to you, Faye.
Alright, Avan, thank you for that information. Virendra, like Avan was telling us, there has been a change in fund management over the last 1 year. But has that change made enough of a difference to the investment strategy? Would you say it's making a difference to how the fund is performing at this point?
No, the fund has been disappointing, and I would say that this fund has been nearly an infrastructure fund. It has a very vague mandate, which is this fund will invest in a manner so that it will benefit from the structural reform, structural changes in the economy, and the ongoing economic reforms. And I don't think there will always be structural changes because of the demography or anything. But economic reform, I really wonder that it has anything going for it. Yes, that was the talk when this fund was launched. This has been a very disappointing fund in recent past. So I would say that this fund, even among infrastructure funds, the way we classify it, has also settled as an average fund. I think one should pull out from such a fund.
But the last time we talked about this fund, you gave it 2 stars. Would you continue to give it a 2-star rating at this point?
Yes, for both things. This fund has become a very generic fund. It looks like any other diversified equity fund without any tilt or focus. And going by its relative underperformance, I would certainly, ask investors to keep away from it. Yes, a 2-star.
All right, 2 stars there for the DSP BlackRock Tiger Fund on Investors Guide. Remember, they are categorically telling us to avoid that fund and pull out your money if you're still invested in it. It's time to move on to our hold or sell segment. Well, Ayush has written in. He has a monthly income of 50,000 rupees. He's a young investor, Virendra. He began investing in mutual funds last year. He wants to know if he should continue with this portfolio. His aim is, of course, to create long-term wealth. I'm going to start right at the top. He has the ICICI Prudential Focus Blue Chip Fund and the Franklin India Blue Chip Fund. Is there an overlap between these 2 funds? They're both impressive. Should he continue investing in both of them?
Yeah, both are impressive funds, but both are large cap funds. And these funds have been very resilient in recent past, but for a 25-year-old with this much of savings and a lot of time on hand, I think he can do without these funds, however impressive they be.
I'm also going to take the next 3 funds together. There's the ICICI Prudential Discovery, Reliance Equity Opportunities, and SBI Emerging Business. For a young investor, are these the kind of funds then that you would recommend?
Yeah, certainly. These are the kind of funds, and they are also very impressive funds. In fact, he has chosen good funds. If you want to have a low maintenance portfolio, a portfolio which you don't need to track every other day, or every few months you need to take action, then I would suggest that you get into a large and mid cap fund, a diversified fund.
But there he has one last fund, the Reliance Gold Savings. Now I know you don't normally recommend this, but he's also written to us saying he plans to get married by December next year. So then, is it wise for him to continue the gold savings fund and just use it to buy jewelry when he is getting married?
Yeah, that's one way of looking at it. But I think on a long-term basis, it's not a good investment. But yes, if you want to de-risk yourself, you don't have the money now, but you think that it is good to average the investment or the money you want to exchange with jewelry, it might not be a bad idea.
So the gold fund, only if you're using that money to buy jewelry when you do get married. Virendra asking you to hold on to the 3 funds, the Discovery, Opportunities and Emerging Business Fund. Virendra, is that enough of a portfolio? Would you like to add something to his portfolio at this point?
No, I think, these 3 funds together, ICICI Prudential Discovery, Reliance Equity Opportunity, SBI Emerging Business makes it an excellent portfolio. And, just to give you a sense of the spread of the portfolio, this portfolio will be spread over about 140 stocks, which I think is excellent, and all segments of the market, and very credible fund performance, aggressive return that we have seen. And of course, he will need to keep an eye on Reliance Equity Opportunity as well as the emerging business. Review our portfolio annually. That should be good enough.
To review the portfolio annually, on your screen right now are the funds that Virendra has recommended you do use. Congratulations on the wedding that's on the horizon, and get back in touch with us if you have any more questions. It's time for us to take a couple of more questions. 30-year-old Jay Ramakrishnan has written in. He's a software engineer from Chennai, Virendra. He has some money that he would like to put away for the next couple of years. He wants to know if it makes sense to choose an FMP, and he has a couple of questions about FMPs. Will he need a demat account? He also wants to know how he chooses from all of the different FMPs available in the market right now. Could you help him out?
One is that, look at the FMP which matches with your time frame. Make sure that you are unlikely to need it in between. There won't be an interim liquidity. To invest in FMPs, you don't need a demat account. Think of it like a term deposit. You get the account statement and you don't have to worry about the redemption proceeds. It gets credited to your bank account anyway. How to choose a good FMP? You don't have much because they are a fixed term fund and they start for a specific period. All you can do is look at how the previous FMPs of the same fund house has done in the past. And that is not very difficult to find out. You can you can find it out at Value Research Online as well. The previous redemptions of the same fund houses.
All right, so we hope that helps. Virendra, thank you so much for spending time with us on Investors Guide.
Thank you.
It's always a pleasure to have you here answering our questions. We look forward to sitting down with you again next week. Coming up after the break, we'll tell you how you should prioritize between your various goals and allot your money so that you can achieve all of them. Stay tuned. Welcome back to watching Investors Guide in ET Now. Thank you so much for staying with us. Let me bring in Gaurav Mashruwala, who joins us now to answer your questions on allocating your money. Gaurav, thank you so much for joining us on Investors Guide. Our first question comes in from Sanjay. Now, Sanjay is a young man who saves about 10,000 rupees a month. Now, he has several goals. He wants to do his MBA next year, for which he wants 8 lakh rupees. He wants to get married in 2015. He also wants to buy property 5 years from now. And he feels the need to buy a health cover for his mother, who's 55 years old. He wants to know how he should prioritize these goals and start investing for them. Gaurav, how would you recommend he goes about it?
Sanjay, great question, and here is my answer. Your priority should be health insurance for yourself and for your mother, and don't compromise on that. Between education, your own education and marriage, you have to prioritize. I would request you that give education a priority and a second importance to marriage. As far as education is concerned, save as much as possible. If there is a shortfall, go for educational loan. Now, for value of saving for that, you may use either a recurring deposit or debt-based mutual fund. For marriage, try and live with whatever you can save. If you can't, and if you really have to because of society pressure, take a small personal loan, but that's not the way to do it. So, go for health insurance, fund your education. If required, take an education loan. Keep marriage expenses to minimal.
Our next question comes in from Rajan, who writes in. He has a 2-year-old baby boy who he wants to invest for. He'd like to have about 10 lakh rupees for his son when his son turns 16. And he wants to know what's the best way right now to invest for a child. Gaurav, what would you recommend he does?
Great that you're thinking about your child's future and so early in life. This gives you a kind of long span to plan and strategize. Since we are talking about fund requirement beyond a decade, equity is an asset class that you should look at. If you have skills and time, create portfolio on your own, but a better way is, since we all are busy with our own occupation, is to go for mutual funds. Do a systematic investment plan. You can start with an index fund which replicates Sensex or Nifty. And once you have confidence, start moving into actively managed funds. Ensure that you monitor your portfolio at once every quarter, not earlier than that, not later than that, or once every 6 months, and keep tracking those schemes. And if there is need to make any changes, maneuver. But equity is an asset class that you should look at.
Last question on the show, Gaurav, is from your namesake. He wants to invest in property and create a portfolio of other investments. Now, he's got nothing so far, and we won't judge you because on this show we believe that any time is a good time to get started. He wants to know how he should begin. Gaurav, what would you recommend he does?
So, Gaurav, at the beginning of your career, or the beginning of the investments, here are the things that you should do. Number one is look at contingency fund. So whatever is your monthly mandatory expense, multiply by 3 and keep aside that money for contingencies. Keep portion of that money in form of cash at home and rest in savings account linked to fixed deposit. That's step one. Second, look at health insurance. If you are working and if your employer is providing health cover, great. If it's not, pick up health cover. Third, life insurance. In case you feel that anything happening to you, you have either dependent parents or siblings and support time your own family, and hence they will suffer, then you may want to take a life insurance for that. And this is called wealth protection. You're protecting your wealth from any uncertainty. After that, we move to second stage, which is savings. Now make list of your responsibilities and dreams. If your responsibilities and dreams are likely to occur in the next 2 to 3 years, choose debt-based instruments like recurring deposit, fixed deposit, debt-based mutual funds, bonds, etc. If they are long-term, like more than 7 to 9 years away, choose equity as an asset class. You can either go for direct equity or make a combination or use equity-based mutual funds. And for an interim period between 3 and 7 years, so all those goals that fall in between that period, use a combination of debt and equity.
Alright, so that's a wrap on Investor's Guide. Thank you so much for watching. Remember, any question you have about your money, spending, saving, investing, write to us. Email ID is at the bottom of your screen. And if you missed something on the show, you'll find a copy of it on our Facebook page as well. You can reach me personally on Twitter. Thanks so much for watching.